Hey, welcome. This is Brandon Rogers with Bradshaw Financial Planning and Mind Your Money. Today, I'm going to give a presentation on the state of the markets. Basically, we're going to look at a little bit of 2021 in review, and then also 2022, what's happening currently, and what some projections are going forward. So again, not obviously when we put this presentation together, didn't really think we'd be in the type of market condition that we're in now, but it's good to really perfect timing for this presentation to really see what is going on now and how things look going forward with some projections and some things that we've got some in front of us for the year. So just to kind of look and get started, obviously we've got some disclosures here from that end, so we'll move past that. The topics and how we got the presentation built out today is we are going to talk about some policy issues and some changes there. Economy, kind of talk about how obviously COVID impacted, supply chain. You're going to hear about supply chain a lot and inflation a lot. So we're going to look at those more carefully. Then we can look at stocks and we get to see how they performed last year and maybe what some projections are going forward. So first one we'll look at is going to be the policy. And obviously we got some midterms coming up, right? So when we look at this next slide here, as far as the rate hikes are concerned, it's a really good chart to really zero in on. I might not, be able to see every single detail here, but what this chart is looking at is talking about the different rate cut cycles that we've had all in the past and how the actual market reacts, okay? So if you really just look at the kind of overview of this chart, first off, there's more green than there is red, so that's definitely a positive. So basically what that tells us is that even though when the Fed does increase rates, then we don't really have a massive impact or a shock to the market itself. So you kind of look at the average returns of the Dow, the S&P 500, and the NASDAQ. Of course, those are the three main indices that we cover as far as U.S. stock market is concerned. So when we look at those different, the cut cycles and also the rate hikes, you can kind of see how that performs. Still, on average, everything looks actually pretty positive. So really, do interest rate increases translate to a weaker stock market? I would say no, based off of the data that we're looking at. So, really key to look at the time frames that we're looking at here, as far as always back from the 80s all the way up until more current time. So, pretty good little chart there that we can see. The next section we'll look at is the policy. Obviously, this is talking about mainly what Biden's tax rate policy, the Build Back Better program that he was really wanting to push through and get passed. Not a lot of this actually went through, right? The market and everyone and corporations were obviously really concerned about the corporate tax rate going from 21 to 28%. You kind of think about what happened, right? If a company has to pay more to taxes, do you think they're just going to eat that and hurt their margins, or are they going to really pass it along to the consumer in higher prices? We kind of think the latter might happen, and that's why it's a good thing that hadn't gone through. Looking at the actual other higher tax brackets as well, that looks like it's still not to be adjusted. There's still some potential times some of these could get changed, but it's probably really unlikely that we're going to see any tax rate changes from that end. Obviously, we got some highlights as far as the children and caregiving, the climate change, again, and the Build Back Better, what he was actually wanted to put in place, but again, just couldn't get the votes to put it through. Obviously, West Virginia played a big factor into that when that happened. The next thing that we're going to look at as far as healthcare in his plan, one thing that actually did change is that he did initially talk about wanting healthcare for all or Medicare for all. That never really went through, but what actually did change was he actually stopped the income caps for the ACA or Affordable Care Act, Obamacare, or whatever you want to think of it as. There used to be an income cap to say, hey, if you made over about $67,000, $68,000 a year, you would get no subsidy whatsoever, and that's for a married filing jointly couple. Well, pretty much, I think it was around March of last year, he did away with those income caps, and I think it kind of went under people's radar. I didn't really realize it. So now what you're seeing people above those income levels actually getting some type of subsidy. So in a way, was it Medicare for all? No, but it is government subsidized health care. So that is something that did go through that actually a lot of people have taken advantage of. If we look at the next slide, when we're looking at policy, again, historically during midterms, there's actually a lot of volatility, but stocks still go up. So we're definitely feeling that right now. Obviously in January 2022, as far as the volatility is concerned, but we expect this volatility to continue for at least the first quarter or so, and I think probably get better towards the end of the mid to the end of the year. Obviously, we look at this chart and it takes a look at the S&P 500 return, and again, after 1 year after a midterm election. So again, you can see through all these different time frames that we still got some pretty positive numbers from that end. So on average, it has gone up about 15%. So again, we don't really expect the market to do as well as it did last year. We'll have a chart to look at here at the end of this presentation that kind of shows that. But we do expect to have a positive year when it's all said and done. Now when we look at the economic impact. So first off, I want to focus on a quote here that Jerome Powell has that we've got here. Of course, he's the Federal Reserve Chairman. It says, in the long run, and even in the medium run, you wouldn't want to bet against the American economy. So I think that's a pretty strong quote. Again, you never really want to bet against it. Will we have some volatility in the short term and midterm or whatnot? Yeah, we will. But overall, don't ever bet against the U.S. economy. Again, don't ever bet against the U.S. stock market. It definitely has its issues and definitely has its downturns. But again, you kind of think about the overall odds. 75% of the time the market's up, 25% of the time the market's down. If you look at it over, say, like a 50-year period, I like those odds. So again, still doesn't do away with volatility. It's there, but we still like those odds, so don't bet against it. We kind of look at the business cycle of where we're at currently. The U.S. is in a mid to late cycle expansion phase. There's easy financial conditions, meaning money's cheap right now, and you can really loan out a lot of money. People can take on debt, hopefully spend it. Businesses can do that to purchase other businesses. They can use it to actually just reinvest in their own company. So again, easy financial conditions are a positive thing because there's more money flow going out there and available. When we look at risk, again, supply side. So we've got a lot of issues obviously going on the supply side of the equation. We think that's really actually driving inflation as well. Don't think it's really a long-term inflation event. And I think the supply side is really driving that, just because, again, things coming over from China or across seas that we use obviously in this country have been lagging. And when you don't have as much supply and demand, right, you got the demand out there with not a lot of supply, you'll see pricing go up. Companies know this and they're charging more for products because consumers will pay for it. So that's why I think a lot of the inflation side has also been affected by the supply side. But the economy is potentially slowing, so we'll just have to see what happens with the Fed, and obviously the tapering is not going to help things out either. But just as long as I think as far as the Fed is transparent, hopefully they'll give us some heads up on what they're going to do, and the market can react appropriately. Implications again, and again, we don't want to be in super high risk asset classes. We want to be in asset classes that perform better and higher inflation and the type of economy that we're in. So it really depends on what you're invested in, and also make sure you're diversified for sure. If we look down at the next chart here, we're going to look at the COVID impact. So again, basically what this is really is illustrating is that this is the COVID downturn in March of 2020. So obviously you can see where the recession begins. Everybody remembers what that uncomfortable time frame of March 2020 was. The market fell about 35% or so in about a 3-week period of time. Again, the quickest type of downturn that we've seen. But then shortly after that, the Fed came to the rescue, propped up the market, started printing money, and it's just been gone up ever since then throughout to the end of 2021. So again, when you're looking at this, you'll see all the different items and events that happened during that time frame. Obviously some bad, scary events, but none of them really kept the market down. So that's when people talk about there's a big disconnect between Main Street and Wall Street. This is really what you're seeing. Obviously during the summer of 2020 and throughout the rest of the year, people weren't going to work. They were doing cutbacks. People were just locked into their house, not doing anything. So that was a big deal. And the stock market kept going up. But again, that's because the Fed really jumped in and really started printing money and putting liquidity out there in the market, helped the market go up, and there you go. What I think happened here too is I always like to see how the market learns from prior events. Obviously, you had the financial crisis in 2008. It didn't act this quickly or this swiftly back then. I think that was kind of a takeaway from that event, is that, hey, the Fed and the government has to act a little quicker to try to get on top of it, and they did. So therefore, when you look at 2020, you had some crazy volatility within the year, but it still finished well positive at the end of 2020. Coming down, looking at next, again, we look at the supply chain impact again. Said we talk about it a lot. Supply chain is definitely impacting a lot of things. They're really seeing the supply chain issues still go on for really throughout probably the rest of the year into 2023 to some extent. You can obviously see the differences on different car lots out there. They don't have new cars sitting out there, right? So that's a big impact. The obviously semiconductor piece, especially in the industry of the vehicles are concerned, they need these semiconductors to do it. I know the local shop Freightliner here is pulling trucks off the line, can't really start because they're missing parts. So again, they'll have sometimes hundreds of trucks out there waiting to go somewhere once they get the parts in. So again, supply chain impact is definitely a huge thing. We'll take a look at the next chart, and we'll look at the inflation impact. So this is actually Consumer Price Index. Again, this is what we're judging as far as where the inflation is. So again, if you look at the inflation impact here at the very end of the chart, it's up 7%. So you look at the Consumer Price Index, again, this is going from the 80s all the way up to now. That was a massive increase, right? You can just see how that line just goes to the sky, basically. And it's really the highest level since 1982, again, almost 40 years ago. So you're seeing some really big time inflation hit. Obviously, everybody's experiencing it. As they go look at the gas pumps, they go to the grocery store. I mean, you're feeling these price increases. So, historically, that's where we're kind of looking at, is where inflation is. Again, we don't think it's going to stay at these high levels. Once some of the supply chain gets under control, hopefully that inflation will settle down. Next slide we'll look at here is actually just kind of look at the different colors of these lines, right? What this chart is really illustrating is that the gold line is going to be the 10-year U.S. Treasury yield. Again, that's going to be your safer assets, your bond fixed income type assets. And then the black line is going to be your S&P 500 earnings yield. So again, pretty much a pretty big gap between those two, as you can see, which basically tells us it's still more favorable to own equities, and it will outperform as far as the fixed income or treasury yields are concerned. So again, be allocated to stocks is really what this is telling us, and we got a pretty good track record there. Yeah, it's a little more choppier line. You got some massive changes in there, especially in that 08-09 time frame, but still, stocks have done well. That's the asset class to really continue to stay in. Next slide we'll look at is really going to be the next two. Actually, we're looking at it is really looking at GDP, the current where we have been recently in the past, where we are currently, and projections going forward. So when we look at the forecasters in the Wall Street Journal, when they say looking at the GDP projections, they did have a higher expectation on GDP for this year, but they did cut that from 4.2% down to 3%. Reason for that? Guess. Supply chain, inflation, COVID, right? So these are the main things that they're looking at, and they did adjust that down. But again, you can kind of see historically where we're at, as far as the projections are, and where we potentially will go forecast in the future. If we take a look at the next slide here from this end, in 2021, again, we had the best growth since 1983, so that's a pretty big deal from that end. Obviously, coming back from the recovery, the reopening, hopefully people getting more jobs. Those are coming up as well. So that's definitely a trend that we're seeing as far as the GDP concern of increasing, and that's all goes along with it. So again, as long as people get back to work even at a higher level going forward, again, the inflation, COVID-19 hopefully goes away, supply chain issues get resolved, you kind of see some forecasting going forward as far as where GDP is looked at around that 4% or so for the year. The final section we'll touch on is going to be stocks. Okay, so we'll look at basically the pretty good performance that we had in 2021. So if we kind of look at the first chart, it's really interesting. This is probably one of my favorite charts in the presentation because it talks about the different returns on the stock market depending on which presidential cycle we're in, right? Talks about what about the government being a split Congress, Are we going to have Republicans in control, Democrats in control, Democratic president, Republican president, and just kind of looks at those different scenarios, and we can see how in the past of what we've looked at. So currently too, basically right here highlighted in big letters in red, 17% correction during midterm years. So yeah, we could have a potential correction. We're actually having a mini one right now, again in January 2022. So we do anticipate a correction coming. I think the last chart that we have on this presentation too really kind of shows some intra-year corrections or fluctuation that's kind of really eye-opening. So we'll definitely touch on that. But if you look at the top one here, obviously look at the presidential cycle of the 4 years they're in office. You can kind of see how different quarters have performed. Q1, 2, 3, and 4, the 4 quarters of the year, obviously. In year 1, on average, presidential cycle, market's up 9%. Year 2 is up 4.9. Year 3, 16%, and so on. So it's really interesting to look at those price changes as far as what cycle or what part of the term the president's in, right? But then really focus in on this bottom part. Okay, so we've got the midterm elections coming up, and let's see how that works, right? So you got pretty much basically the political scenario of a Democratic president and a Republican president. You can kind of see the returns there, okay? But then really look at the parts that we highlighted here in gold. When we look at a Democratic president, which obviously where we're at now, and you have a Republican Congress. So if that happens, the S&P average return is about 13%. And that's something that I think is a possibility. Or you have a split Congress with a Democratic president, which means there's gridlock, right? So you have maybe one house, one's controlled by the House, the other controls the Senate, right? So when you're looking at that, it's really the market on average is up 13.6%. Market really likes gridlock, deadlock. Nothing can get passed, no major changes can happen. So they say, hey, the tax policy and the economic policy that's in place now will probably stay about the same because nothing else can get passed. So therefore, the market likes that stability and usually see positive returns. So that's what we feel is probably on the horizon, which looks pretty solid when we look at it historically. So that's a really key point to look at and keep in mind. The next one we'll look at is going to be, again, within 2021. We can look at how the individual indexes have done in the U.S. economy and also the global economy as a whole. So if we kind of look at the top of the line, it's going to be the S&P 500. So again, had the best performance out of the ones we're looking at. If we look at the NASDAQ 100, that's going to be the 100 basically largest stocks within the NASDAQ or the technology side of the equation as far as market cap is concerned. Up at 26.6, and then we got the Europe as a whole. That's really what the Europe stocks, the Europe 600 is, up 22.2%. Got your overall NASDAQ, which is again going to be 2,000 or so individual stocks within it. Again, mostly tech stocks, non-financials. Then you got the DAX, the German market. You've got the UK market, and then you've got Japan and China within it. So obviously you kind of see how that looks. Really what this tells us is we weren't really big in at all, or we weren't in international at all really. And that was obviously the right call looking in hindsight of 2021. So that panned out pretty good, but still look at the opportunity here in the US markets. So then we take a look at this next slide. Basically it just talks about the different sell-off periods that we had and the performance in the S&P. You can see it being up about 26.9%, the Dow being up 18.7%, the NASDAQ up 21%. There's pretty good separation probably the beginning of the year through these indexes, and then they all looks like came together. So not too much of a difference between it, but just different indices that we look at as far as where the overall stock market is and depending on which index you're looking at. But again, also one of the reasons the markets were up is because the bond investments. Think about the safe money. Interest rates have come down. That affects bond yields, right? So there really wasn't much opportunity in the bond market, and really the overall bond market was negative. So people actually just didn't have a choice at all and had to go to stocks. So you probably saw more people holding stocks just to get some type of gains from that in, and it worked out. So very important to keep abreast of the fixed market as well as the Treasury market on the 10-year, and as these interest rates potentially change. Taking a look at the next slide, we'll look at the different business cycle, which business cycle we're in, and which equity sectors should you hold, okay? So this chart does a really good job of really illustrating it. Trent and I really use this as far as making determinations decisions on what sector should we hold depending on what cycle we're in, right? So you can kind of see as early, mid, late recessionary type cycles, you can kind of see which ones we want to hold, right? So, basically during the current cycle that we're in, we want to hold maybe some dividend paying stocks, some utility type stocks. We want to hold consumer staples type stocks. So again, think about that. That's, you open up your pantry, there's day-to-day life items from Procter & Gamble, Johnson & Johnson, things of that nature that everybody uses on a daily basis. So again, it just tells us to what sectors to potentially overweight on that usually outperforms during that time. So a really good chart to really show which sectors usually do better. Okay. The next slide we'll look at, ton of information on it, but the main thing, this is just called a Calend Chart. What it really tells us is it gives us a good time frame here from 2002 up to 2021. Each different color of the box is a different sector, right? So we've got the large cap stocks. If we look at 2021, we just kind of covered those returns, so let's look at it. Large cap equity is going to be kind of like your S&P 500. It was up over 28%. You got real estate was a good performing asset class. Energy was a good performing as well. Small and mid cap stocks are in here. So again, each color represents a different sector. And the main point here is you don't have one particular color that's always at the top or in the bottom or in the middle or whatever. All asset classes perform a little differently, and that's why really diversification is key. And that's really what this chart shows. Okay, so really neat little visual there. I like seeing that. A lot of clients like that as well. So look at the final slide. Again, this is something that I really like looking at. So what you're actually seeing here is that, again, you're looking at midterms. So historically, they involve market corrections, but long-term gains are likely. Again, that's what we're experiencing right now. So you kind of see where these arrows are kind of pointing down. We'll kind of point it out. So you look at the first one here in 2003, market was up around 28 or so percent, positive year, kind of similar to what maybe did last year. The next year following that, the market did come down, obviously, or it didn't have as highs like you had the year before, but was still up around 10 or so percent. Look at the next time that happened when the market was up was going to be the 2009 time frame. The following year, market still did good. It was up about 15 or so percent. And then finally, you can see the final area there. So what we're showing here is just, again, when we come off of markets like we had last year, the next year, the following year is not as high, but still positive from that end. But the main thing I really want to point out on this chart is going to be the red blocks below it. And that really shows you volatility inside of that year. So again, go back to 2020. Again, the market started up about 6 or 7% the first 2 months of the year, tanked about 35% in the month of March, turned around, went back up, got it all back, and then some, and finished the market was positive for 2020. So talking about some crazy roller coaster ride, it definitely was. So the red boxes down here talk about the intra-year decline. Again, that's really where emotions kind of run high. That's why you should never really judge the market on a day, a week, a month, or really even a quarter, right? You need some time under the belt because you're going to have that fluctuation throughout the year. And again, I think that's really what we're experiencing now, but it's pretty massive to just see the movements of the market throughout the year. Most people just say, hey, where do we end the year? Where do we start the year? And just see what that final number is, and don't really look at the actual change within that year. So pretty powerful slide. It really puts things in perspective. So that wraps up the presentation on it today. If you got any questions, obviously just let us know. We'd be happy to answer them for you. Reach out to us via phone or email. We did a podcast recently that talks about some of these other changes that are coming out, and we're getting those out. We got new ones out coming all the time. So if there's any ideas there that you want to hear about, let us know. We're on every major podcast platform out there. That's really good. Just search BFPUniversity and it just should pop right up. And then you can kind of look at all the social media aspects that we're on. We've got a YouTube channel out there that has all these videos that we've done in the past, and also obviously our website is actually good as well, BradshawFP.com. We'll have all our past videos on it as well. So thanks for joining us. Let us know again if anything comes up, and hope you have a great rest of the day.